again and welcome. This is Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Today is September 20th, 2022, and we're going to talk about our market insights and observations today. What are the three things that are actually moving markets? Markets were actually down today and started working their way back, but still ended negatively in negative territory, both for the Dow and S&P and the NASDAQ. That being said, NASDAQ was touching on some positive signs today simply because interest rates, even though interest rates were super high, even the 2-year and the 10-year, again, the 2 years closing close to 4%, and the 10-year is about 3.56 by the time I taped today. That being said, that's still an inverted yield curve that shows that the short end is doing the work of the Federal Reserve. Now, what's square in the all sights of everyone from the market to investors tomorrow is what the Federal Reserve is going to say. They started their first of their 2-day meeting, but tomorrow is when the press conference comes after their news release, and Federal Reserve Chairman Jerome Powell will basically, we believe, go in line with what they forecasted, what everyone's anticipating, which is the 75 basis points, not 100, but that's always the fear, especially as we started off today's trading, where they go too far, too fast, too quickly. That being said, we all know that the Fed's behind the yield curve, if you will, by the inverted yield curve. We know that they have a lot of work to do because the terminal rate has to go higher than the inflation rate. Think about it like the CPI or the PPI reports. Now, there's some positive signs here in the United States in terms of our business journals. Some of the consumer sentiment and the business service, the U.S. business owner survey, those are starting to turn over. Negative sentiment is starting to build up. And if you think about it, for the business owner standpoint, if the business owners start pulling back on hiring, they start pulling back on CapEx spending, that has a knock-on effect in terms of negative to the wealth effect. And that's exactly what the Federal Reserve is trying to do. By raising interest rates, they can't bring down inflation. But by raising interest rates, the Federal Reserve can suck out the liquidity. Just look at some of the markets, like the real estate market right now is actually on the new home starts, as well as the building permits for new homes. That's coming down significantly, which is sort of what the Federal Reserve really wants to do, is slow down, pump the brakes in the economy. But we're all worried, the market's worried, is, hey, don't overdo it. Don't hit like an emergency brake on us. Just tap it so it slows down. And that's what the really million-dollar question is right now. In the meantime, we're going to watch the U.S. dollar. The U.S. dollar is very impactful for earnings and corporations here, but also just the way the global economy works. And if we can see right now, there's a couple more probably weeks ahead of the dollar probably hitting higher highs for this year. But that could be a peak. And if it is a peak, that could set up for a fourth quarter rally, which is a risk-on rally. So that would be a very positive sign. Another reason to be, hey, wait a minute, let's make certain that we're positioned appropriately, because even though it looks really, not favorable right now in the equity markets, some signs of pressure relieving, meaning the U.S. dollar coming back, could actually be a super positive for the equity markets. So higher highs in the short term for the U.S. dollar, but if that dollar reverses and actually peaks, we could see, again, a risk-on rally or markets move higher, the equity markets specifically. Now let's talk about markets and midterms. Markets and midterms, if you've joined us before, I just want to recap this. This is important. Historically speaking, if you look at a presidential cycle, so the first 2 years is sort of choppy with regards to stock market returns in correlation to how the presidential cycle goes, but it usually is the midterm cycle. So it's basically at the end of year 2 when you have midterms, like we do this year in 2022, and markets historically, overwhelmingly trade higher. And that's because you have divided Congress. It doesn't mean if it's red or blue, it doesn't matter. It means that spending in Congress, because of divided Congress, could actually have a positive effect, because you can't spend money when you can't agree on even what time to go to lunch. And so if that actually plays out, which we believe it could, if you look at sort of how all the real clear politics shake out right now, a divided Congress spells that no more spending in Washington. No more spending means, that's one of the reasons why we got here in the first place with regards to peak and high inflation, even a strong dollar, as a matter of fact. So if we slow down the step of spending, or we stop off, basically we have monetary policy and fiscal policy both slowing down, we could see a peaking inflation, a peaking in dollars for the U.S. dollar, which is all setting up better for the U.S. equity market. You just have to go through this. Now, the question is, does the consumer hang in there, and do corporations hang in there? Well, keep in mind, corporations, those will get stronger and get stronger going through a recessionary period, as well as they will stop hiring, and they will also start laying off. And we're seeing that. And as they lay off, they're protecting the bottom line of basically corporate earnings. So we haven't seen earnings actually fall off just yet. They're only down about 3% of what's projected by FactSet for 2023. So there's a solid sort of earnings, even upside for next year. So that's what keeps markets in. So we haven't seen any revisions down to earnings. Now there's some big companies that are saying some revisionary things here and there, but it's not across the board. So it's basically going to be pick and choose type market. So that's our setup for today. That's what we're watching, as you should be too, as the market plays out. But we'll see what the Federal Reserve Chairman has for us tomorrow. Remember, last time he was super hawkish. This time, and then markets sold off accordingly. This time, markets sold off in anticipation of him being super hawkish. So we could see what type of Jerome Powell shows up tomorrow, and then markets have already positioned for a downside, and so we could see maybe a counter trend rally play out. Tune in and we'll see how it goes. Thanks for watching.